Hello, everybody. I hope you had a great week and we are pursuing and achieving our dreams. Thank you for joining us this afternoon. We have once again an insightful conversation with Themba. Themba is an expert personal finance. He's an expert in personal finance. And if you have any questions or comment, we encourage you to post it in the comment section and we'll address it. And invite a friend, take somebody and share the video so that we grow together. Our dream is worth fighting for. Yes. I'll just quote what Themba said last week. He said many people who are not investors work for money, but money must work for you. We do not idolize money on this show. Money is a slave and it should work for us. So I hope we are all working towards having money work for us. So as is mentioned, as much as we encourage wealth creation on the platform, we do not idolize money. Money is a tool which is supposed to work for us so that we impact our generation, we do more. We also discussed earlier in the show that if you don't have money, it's very difficult to be influential. So if we desire to be influential, we need to create wealth for us to be able to do so. Themba, is there any news you wish to bring to the attention of our viewers or of our audience this afternoon?
I like what you say, Tafadzo. On this show, we don't idolize money. We are all about spreading education on financial independence, how to be financially independent. In my life, I've grown to understand that the greatest reason why people do not have breakthroughs is essentially ignorance. We should try as much as possible to empower ourselves with knowledge, which is what we are all about. All right, there was something on my throat there. Tavadzo, you've asked me to share any news which may be of interest to our audience. Three things that I would want to bring to our attention, to our viewers and to our listeners. The first thing is, I think we received news from Stats SA that the economy in South Africa grew in the last quarter by only 0.1%. And there was quite a lot of celebration in the financial media that South Africa had dodged the recession. All in all, the economy in 2023, that is the South African economy, grew by 0.6%. There are three things that I would want to share with our audience arising from that publication by Stats SA. The first thing is that when I went deep into the numbers, Tafadzo, it became clear to me that while the economy had marginally grown by 0.6% in 2023 and by 0.1% in the first quarter, agriculture as a sector had recorded the first annual contraction since 2019. It shrank by 12.2%, which is the biggest annual fall in production since 1995. The reason why I'm particularly concerned about that, Tafadzo, is because of a report that I also saw on another website. And this report was a report written by a guy called Philip Kofi Adom of the Center for Global Development, Energy and for Global Development. This guy is environmental and energy, economist. He basically said in that report that if climate change continues on its current trend, crop production in Africa will decline by 2.9% in 2030 and by 18% by 2050. And as we know, 42.5% of the working class in Africa is employed in the agricultural sector. If that happens, about 200 million people in Africa risk extreme poverty by 2050. The thing that I'm trying to communicate there, Tafadzwa, is that when I look ahead, I think there's need to raise entrepreneurs in the world of agriculture. There's, because of the rate at which population is growing, and because of the importance of that particular sector, I just feel that not much attention is being paid to agriculture. And I also feel that in the next few decades, the wealth that will be created will be in the area of agriculture. So that's one thing that I would want to say in response to that news. The second thing that I would want to say is that whilst people were celebrating that marginal increase in economic growth, there isn't really anything to celebrate about, Tafazo, because we've got a situation where the economy in 2023 grew by 0.6%, but the population in South Africa grew by 1.5%, which means that the population is growing at a faster rate than the economy is growing. And what it means is that the GDP per capita, or the amount of GDP that can be allocated to each person in South Africa, is actually shrinking. So people are becoming poorer in South Africa. And it's a point that was raised by an economist in a particular interview. His name is Martin Ackerman, who is the chief economist at a fund management company called Citadel. He makes the observation that South Africa is in a GDP per capita recession. In other words, the GDP, while the whole economy is not in a recession, but when we look at GDP per capita, the economy is in a recession. If you think about the situation that inequality in South Africa is growing, and you also superimpose this insight that the GDP per capita is shrinking, then what it just says to you is that the economic picture for the average individual in this country is grim. And if the powers that be do not do quite a lot in terms of implementing reforms in the economy to address some of the structural issues, then it's not good news, for the rest of the population, because it's not as if the rich are not becoming richer. The rich are actually becoming richer, which is why we have to have these kinds of shows, Tafadzwa. It's because the only thing that can cause an ordinary person to join the rich, as it were, is education. If we rely on what politicians are doing, what economists are doing, we're not going to make much progress, and we will fall into the bracket of extreme poverty. And just talking about the growth issues again in South Africa, I also went deeper into the numbers, and it was quite clear to me that whilst the economy in South Africa is larger than it was before COVID, it's actually smaller than it was in the second quarter of 2022. So the economy definitely is not growing. So that's the one thing that I wanted to say. The other thing that I wanted to say, Tafadzwa, is that in this week, I know, Tafadzwa, you've heard about Bitcoin, this cryptocurrency called Bitcoin. Bitcoin recorded its record levels in this week. So the previous record that Bitcoin had achieved was $69,000. And that was in 2021, I think. I think it was in November 2021. But in this past week, momentarily, Bitcoin broke through that level. I think it reached a level of 69,200. And one of the reasons why Bitcoin went to record levels in this week is essentially because regulators, particularly in America, are beginning to develop a favorable view towards Bitcoin. And we have seen regulations being published with regard to investing in Bitcoins. And we've also seen some institutional investors in America, particularly, creating funds that include Bitcoins as part of their portfolios. And there are two implications on that I would want to just say now. The first implication is that I think people should take a look at cryptocurrencies as an alternative investment. Today, Tafadzo will be talking about alternative investments. And one of the examples of alternative investments is definitely cryptocurrency. Last year, we gave an advisory that people should not touch cryptocurrencies. At the beginning of the year, we updated that advisory and we said, consider allocating part of your capital to the extent of 5% of your portfolio in cryptocurrencies. And then later on, I'll explain why cryptocurrencies should be part of our portfolios. Obviously, this is a volatile asset class, so you shouldn't allocate, a significant portion of your capital to cryptocurrencies. That would not be wise at all. But as part of your allocation into alternative investments, consider cryptocurrencies, but limit it to 5% of your portfolio. My view going forward, and we also take the time on this show, Tafadzwa, to predict trends. And so far, I've predicted a long-term trend. When I talk about a long-term trend, I'm talking about things that will happen in decades to come. I think agriculture is a sector that will create wealth. It's something that is being ignored. And it's something, and the reason why it's like that, it's a no-brainer, Tafadzwa. Population is growing. There is very little interest in that sector, but also climate conditions are not helping. We've had extreme weather, and that extreme weather has affected yields. And therefore, there will be demand for food, given the low yields that we have experienced. And so somebody who is quite creative and innovative has to look into that. So that's the first prediction that we've made. The second prediction that we would want to make is that there is going to be an increasing acceptance of cryptocurrency into asset portfolios. Previously, a number of institutional investors have not touched cryptocurrencies. They were waiting for regulations to be tightened, but I think there is increasing acceptance. And therefore, it's an asset class that we must consider looking at. But I would want to make another observation, Tafazo, and this is a very important observation. You probably might have received calls, emails, pop-up messages when you open your internet browser around, invest in cryptocurrencies. You'll double your investments. Most of those messages are actually scams. So yes, we like cryptocurrency. Yes, we would recommend that you allocate a percentage of your capital towards cryptocurrency. Obviously, you limit it, but we must also be careful about investment scams. I think a lot of fraudsters are going into that area and persuading many people to part with their hard-earned cash and invest in cryptocurrency in a way that is not legitimate at all. So do me a favor, if you don't want to part with your money, don't listen to investment advice from your friends, because most of these scams are nothing but pyramid schemes. It's all about recruit somebody so that you can also, they can also participate in some kind of investment scheme. Those people are not actually investing in cryptocurrency. They make their money from recruiting people. And so let us just be careful about investment scams. We always advise our audience not to invest in, number one, anything that is shrouded in secrecy. Number two, not to invest in anything that is not well regulated. Number three, not to invest in anything that you have not done due diligence on. In other words, somebody just stands and markets how this one has made money. And the way it's done is very simple, Tafazo. You are invited to go to a presentation. At that presentation, you hear stories of how people have made wealth overnight. There isn't much discussion around the business model of making wealth. It's all about this one was poor and they've made so much money. And then some of these testimonies or the things that people are talking about are actually persuasive, and it's so easy to fall for it. So let's just be careful about these investment schemes. The last thing that I would want to talk about, Fadzo, is also news that concerns Zimbabwe as an economy that we received this week. Um, the United States has relaxed sanctions on Zimbabwe, after 21 years. And unfortunately, they have still maintained targeted sanctions. And these sanctions are targeted towards, some of the leaders in Zimbabwe. But as far as the economy and as far as business is concerned, sanctions have been relaxed, and I think that's a good development, Tafazo. It's a good development in the sense that there is nothing that then stops an investor who comes from America or from abroad in investing in Zimbabwe. We know when the Americans say that you are under sanctions, then a number of businesses take the cue from what America is saying because they operate some of the systems in the world, and therefore they are reluctant to commit capital to Zimbabwe. And, in a small way, I think it's the beginning of greater things in Zimbabwe. That's my view. My view is, progressively, we're going to see capital going Zimbabwe's ways. It's not going to happen immediately, though, but at least from an investment point of view and from an inflow point of view, if the sanctions have been relaxed, it sends a positive signal within the business world, within the investment community, within the foreign direct investment community, that there are no restrictions in terms of investing in Zimbabwe. Obviously, more could be done in that economy, but I think that's a welcome development. It sets Zimbabwe on some path towards recovery. It's going to be a shaky journey towards recovery, but at least I think there is a turning point there, Tafazo. I think let me stop there and just focus on those issues, Tafazo.
Thank you for those insights. Do not invest in something that you have not done due diligence. Today we are talking about alternative investments. What is your recommendation for the book of the week? And would you also give us your thoughts of the day?
Good, Tafazo. I hope you can see my screen. The book that we are recommending in this week is a book that we spoke about last week. And the reason why I'm bringing this book again is because last week I hadn't actually read the book. I think I indicated as such, I had just purchased the book. But during the week, I had the opportunity to actually read the book and hear what Tony Robbins is saying and hear what his colleague Christopher Zook is saying. Christopher Zook, I later on found out that he's a guy who had founded an investment company. So he's a guy who knows what he's talking about. And I later on, got to understand why Tony Robbins had written this book. It's because he coaches a number of successful people. And I totally agree with everything that he says in this particular, book, Tafazo. For those of you who didn't listen to what we said yesterday, this book was released on the 13th of February, 2024. And before then, people could pre-order, but now it's available on Amazon. I think when I looked last week, there was a list price of 30 US dollars. It's a book that I would recommend us to read. There are three things that he says and that I learned from this book, Tafazo. The first thing that I learned is that the smart money, when we talk about the smart money, we're talking about the investments that are being managed by the ultra rich of this world. Smart money uses alternative investments to fuel accelerated growth in their investment portfolio. So Tony Robbins, because of the work that he does, he had an opportunity to look at the asset allocation of some of the ultra rich people in this world. And he noticed that 46% of their assets were actually invested in alternative investments, and only 29% were invested in publicly traded stocks. And he makes the observation that the rich are actually making more money from alternative investments. He makes the observation that while least money was made in the stock market in years gone by, that's no longer the trend. In fact, one of the things that he says, which I totally agree with, is that the number of listed companies has gone down over the years. And if you know anything about the Johannesburg Stock Exchange, Tafazo, you will know that the number of companies on the JSE has also, gone down. Many companies are finding alternative ways of raising capital instead of going on the stock exchange. And also, given the regulations that one is to abide by on the stock exchange, it's no longer always advantageous for companies to be on the stock exchange. And that was quite an eye opener, for me, to realize that the rich have allocated a significant portion, just slightly less than half of their capital towards alternative investment. The other thing that he says, which I only got to understand after reading this book, I had read years ago books written um, by a number of investment gurus. And they always talk about the concept of an accredited investor, a qualified investor, a sophisticated investor. I only got to understand that this is how the American system is structured. So if you get to a certain level of net worth, Tafadzwa, the Security Exchange Commission, the SEC, will actually invite you by virtue of your net worth to be called an accredited investor. And then if you reach another level of wealth, you become a qualified investor. So some of these alternative investments are not available to the public. They are only available to either accredited investors or qualified investors. In other words, the rest of the people who are in Main Street, I'm talking about the public, are being made to invest in publicly traded stocks. The rich are actually investing in alternative investments. And by virtue of them having money, they then get access to investments that yield high returns. And in reading this book, obviously, Tony Robbins also indicates that there is pending legislation in America that wishes to democratize the whole process of investment, so that these kind of investments, which we are calling alternative investments, are also available to the men in the street as well. So what then does it mean to all of us? I think what it means is that don't wait until you've got a lot of money for you to participate in some of these investments. The key is empowering yourself with knowledge. The key is learning how investments work. Our advice, Tafazo, which we have given on this show, is that if you want to learn investments, start on the stock exchange. Right, start on the stock exchange. It's highly regulated. Your money is safe there. You will lose money, you will gain money, but more importantly, you are going to be experienced. And that kind of experience will then qualify you to do greater things and to expose yourself to more risky investments. So we still maintain that it's advisable to build a portfolio on the stock exchange. Once you've gained knowledge, then you can go into alternative investments, because that's where the world is actually going. Obviously, the title of the book is called The Holy Grail of Investing. I got to understand reading this book, Tafadzo, that what he calls the holy grail of investing is actually building a portfolio of 8 to 12 non-correlated high quality investments, which together will reduce risk without sacrificing return. Now let me just move slowly in defining what that holy grail of investing is. As you know, Tafadzwa, investing is all about understanding risk, vis-a-vis return. So that risk return relationship has to be understood very well by an investor, because that's very, very important. As you also know, Tafadzwa, investing is about building a portfolio of investments and allocating capital to different types of investments. I think the one thing that you will learn from this book is the whole definition of diversification, because many people don't understand what diversification means. But you know, and I totally agree with what Tony Robbins says when he defines what diversifying a portfolio is all about. He defines diversification, in terms of correlations, correlations. So when we talk about a correlation, we're talking about the relationship between two variables. So if you are saying one variable is highly correlated with another, it means that when variable A moves up, variable B also moves up. So that's high correlation. If there is negative correlation between two variables, it means that when variable A moves up, variable B moves down. So diversification is all about having stocks, having investments in your portfolio that are not correlated with each other. Because sometimes we think that when we invest on the stock market and we've got different shares, we have achieved diversification. No, we haven't achieved diversification, because what tends to then happen is that if the price of one of the stocks in your portfolio goes down, then all the shares in your portfolio also go down. And therefore, there is a very strong correlation in your portfolio. So your assets in your portfolios are not uncorrelated. So what he basically says, which is the holy grail of investing, I must point out, Tafadzwa, here, that in coming up with this book, Tony and his co-writer sat down with 13 of the leading investment minds in the world. So here we're talking about, just to give you names, people like Robert F. Smith, who founded the Vista Equity Partners Fund, who is recognized as the most successful enterprise software investor in history. We're talking about people like Vinod Khosla, who is the founder of the Khosla Ventures Fund, and who is also a legend in the world of private equity. And people like Michael B. Kim, who is revered as the godfather of private equity in Asia. So in writing this book, he sat down with all these people, understood what it is that they are doing and what has made them successful. But at the end of the day, it's about investing that smart money in alternative investments, It's also about building a portfolio of 8 to 12 non-correlated, high-quality investments, which together will reduce your risk without sacrificing return. And in that statement, Tafadzwa, he's basically saying when you invest for the long term. So it's about preserving your return. So you need to understand risk as well, because risk are those factors that reduce your return. So at the end of the day, Tafadzwa, this is the book that I continue to recommend to everyone. But I've gone through the book myself, and I would be willing to continue to share some of the insights that I got from the book. In terms of our thought for the day, the thought for the day is that asset allocation accounts for 90% of your investment success. And this is one of the insights that is shared by one of the gurus in investment. When we talk about asset allocation, we're talking about how you divide your investment capital between different asset classes. So, for example, if the rich are on average allocating 46% of their capital to alternative investments, that decision becomes very important to understand, because how you allocate your capital is 90% of your investment success. If most of your capital is allocated in publicly traded stocks, given the trends that we are seeing, it's unlikely that you're going to achieve that investment success, that he's talking about. So just know, for those of you who are embarking on an investment journey, and we advise all our audience, all our viewers and listeners to embark on this journey, how you allocate your capital. So far, we have guided you in two ways in terms of how you should allocate your capital. The first guidance that we gave is allocate some capital towards cryptocurrencies. So limit it to 5%, limit it to 5%, and then increase it, over time, because cryptocurrencies are an asset class for the future. We're talking about an increase in cryptocurrencies in this past week because of how regulators have come up with rules as far as cryptos. Unlike in the past, I think we're seeing more regulation in that particular area. So that's the first guidance that we've given. The second guidance that we've given is that you must increase your allocation in alternative investments. So instead of, if you've been following us, instead of having all your capital in publicly traded shares, not that there is no money to be made in publicly traded shares, you are increasing your allocation towards alternative investments because of your understanding, number one, of diversification or correlation, but also number two, because of your understanding of the potential in terms of returns in this particular, asset class. So don't forget that in your journey of investment, how you allocate your capital accounts for 90% of your investment success. Before I hand over to you, Tafadzo, there is something that I would want to really communicate, which is communicated in the book that I was talking about. Being a successful investor, an expert investor, does not mean that you will not lose money. You will lose money. If you have invested money on the stock market, you will know that you will have winners and you will have gainers. You will have gainers, you will have winners, but you also have losers. You will have assets that will go down in value. The thing about investment, and later on we'll talk about the immutable laws in investment. The thing about it is not to be so much concerned about whether you've made the right decision or not. The thing about it is that you should make sure that your asset allocation is, the right strategy, but also you should understand risk reward ratios. And I'll go into detail on that as we proceed with the show, Tafadzo.
Thank you very much, Themba. That sounded a bit technical, but I wanted to ask the two questions. Why are companies leaving the stock market? You say there's a drop of companies being listed on the stock market. Then the second question, you spoke about building a portfolio of like 8 to 12 share so that like there's diversification. If I mean, like as you said, you must use like minimum amount to invest. So if I have to look for 8 to 12, doesn't that affect the amount of money that I allocate to each share? And doesn't that also affect the results? Rather, maybe if 2 or 3, which you can invest more money into. Because if maybe I have 5,000, I want to invest. Then if I then have 12 share classes I need to invest, then it means the allocation for each share is low. Then yeah, I think I also wanted to ask, like, how do you also see that they are correlated or they're not correlated?
Tafadzo, I like what you said. The intention in this show is not to be technical. Investing is not complicated at all. You might have found the word correlation to be technical, but the way we tried to break it down is that economies move up and down. Economies move up and down. Stock markets move up and down. There is risk. In fact, when we talk about risk, risk is not a complicated term. We are talking about moving up and down. So if you invest in a share and the share is moving up and down quite a lot, then it's a risky stock. It's a risky share. So think of risk in simple terms as the movements up and down, right? It's given in this world because of how the world has been created, things will always move up and down. So when you come into the world of investment, you must understand that on the one hand, there is risk in the markets. It's not as if when you invest, things will continually go up. Because sometimes people come to the investment world and they think that share prices go up and up and up and up all the time. No, they move up and down. And that up and down movement is what we are calling risk. We also used the term diversification. The concept of diversification was introduced or spoken quite a lot by people like Benjamin Graham that we spoke about the last time. The reason why investment, one of the immutable laws in investment is diversification, is because you preserve by your capital by investing in a number of assets with the hope that when one asset goes down, obviously another asset goes up. And therefore, overall in your portfolio, you're going to have an upward movement in the price of your portfolio. So what we have simply done by introducing the term correlation is to explain the term diversification quite a lot, to really explain that the real kind of diversification is understanding correlation. And correlation is the relationship between variables. If one variable goes up, another variable also goes up, there is positive correlation between the two variables. If one variable goes up and the other variable goes down, there is negative correlation. That's an important concept for what I would want to explain later on. But let me go quickly to your question, Stefanzo. Why are companies not going through the stock market anymore? Tafadzo, one of the reasons why companies list on the stock market is because they want to have access to capital. They want to raise money. Nowadays, because of how the economy is, a company can raise capital from private investors. They don't necessarily have to go and raise that capital on the stock market. So, because it's possible to raise capital from private equity players, from venture capitalists, it's no longer attractive for companies to always go on the stock market. The second reason has been, if you are running a company, there are onerous requirements with maintaining a stock listing on any of the stock exchange, because the companies that operate these stock exchanges are in one sense regulators. They have got rules that companies have to abide by to be listed. So those rules could be onerous. For example, if you're in America, you have to publish your results on a quarterly basis, and there is quite a lot of scrutiny. So some people, just find those regulations to be too onerous. And therefore, if they can raise capital in private hands, they then don't go through the stock exchange. Then the second question was on building a portfolio. When I spoke about 8 to 12, number one, I wasn't necessarily talking about shares. I was talking about high quality investments. Those investments could be in different asset classes, right? So that's the one thing that I would want to clarify. The second thing that I want to clarify, there is that if you are doing investment on a monthly basis, right, you are beginning. That's for beginners. Remember what I said, begin on the stock exchange, invest on a monthly basis until you build a portfolio, right? So once you then build that portfolio, you then decide how you would want to allocate the capital in that portfolio. Once you've reached a critical mass, you may want to liquidate your stock exchange and begin to go into private equity. And therefore, you may then decide to buy different kinds of assets. It doesn't have to be 8 to begin with. It doesn't have to be 12. But that's how Tony Robbins, defines the holy grail of investing. When you have reached a certain critical mass, remember, you need to reach a certain critical mass, at some point. So that then answers your question, Tafadzo.
Thank you. I think I some clarity on that. You have brought up the concept of asset allocation in your thought of the day. What really is this concept, or you have already explained it?
So I've explained it, Tafadzo. Asset allocation is basically the decision to divide your capital between different assets. Traditionally, and I'm going ahead of you now, Tafadzo, there are assets that we call traditional assets. Then there are assets that we call alternative assets, right? So when you allocate, initially asset allocation was understood as how much you divide your capital between the traditional asset classes of shares, bonds, or fixed income instruments, and cash, right? So what percentages do you allocate? And sometimes you may want to allocate capital to gold. So the traditional wisdom in investments is that you must have, as part of diversification, allocation of capital to shares, to fixed income, to cash, and also to gold. So how much you then allocate to each of those asset classes is what we are calling asset allocation, right? Which is 90%, as we said, of your investment, decision. At the beginning of this show, we said smart money is being allocated towards alternative investments. So it's a decision that you have to make, to begin with. That's what asset allocation is all about. So our advice is allocate, an amount, to cryptocurrencies, at least 5%, because the world is changing, Tafax.
You have also referred to the book by Tony Robbins. Are there any immutable laws of investing that Tony and Chris talk about in their book?
Yes, they are, Tafadzwa. In his book, he talks about 4 immutable laws of investment. We have touched on these laws, so I will go through them very, very quickly. So even as you go into investing in alternative investments, don't forget about those immutable laws. Law number 1, never lose money. Always preserve your capital. This is something that Warren Buffett always says, Tafadzo. When you go to invest, never lose your capital. So you do due diligence. You make sure that you don't risk too much on any investments. So you don't want to go into one invest. Don't lose money. So that's rule number 1. In fact, Warren Buffett is very famous for saying the number 1 rule of investing is never lose money. The number 2 of investing is always remember rule number 1. So that's how Warren Buffett thinks about this rule. Rule number 2 is asset allocation. So spread your assets on different types of assets with varying risk reward, ratios. That's rule number 2. So never lose money, allocate your capital, accordingly. Rule number 3, look for opportunities with, asymmetrical risk reward, ratios. What it means in simple terms, because we don't want to, we talk about symmetrical, risk reward relationship. Now we are talking about asymmetrical, risk reward, relationship. What we are simply talking about there is that look for investments where the potential return far outweighs the risks involved, right? Investment is about balancing risk vis-a-vis return. It's about balancing risk and return. When you invest in any investment, there is always risk, right? There is no investment that is not exposed to risk. Even the safest of all investments have got risk attached to them, right? So when you are investing, you'd want to look for assets whose return far outweighs the risk. So they've got an asymmetrical, risk reward relationship. Those are the kinds of investments that you are looking for. And that's where alternative investments, fit in. So that's rule number 3. Rule number 4 is diversify. So own a variety of assets. Those are the 4 immutable laws of investing, Tafadzo.
Thank you for those 4 immutable laws of investing. Since we're talking about alternative investments today, let's start by defining what they are. What are alternative investments? You've spoken about cryptocurrencies. Are they also alternative investments?
Simply put, Tafadzo, anything that is not shares, bonds, or fixed income instruments and cash is what we are referring to as alternative investments. So there are quite a number of alternative investments that we can talk about. The reason why they are called alternative investments or alternative assets is because they are alternative to those traditional, assets. But these alternative investments normally have got 3 characteristics, right? So characteristic number 1 is that compared to your traditional investments, they are lightly regulated. There is less regulation on alternative, investments compared to your traditional investments, which is one of the reasons why we must be very careful when we go into alternative investments. It's because there is less regulations. That's why I always, advise people to start with the stock market. The stock market is highly regulated. It's got traditional investments. Once it's just like being a child, Tafadzwa. You start by crawling. Then so crawling in the investment world is like investing in shares. Then you start to stand and to walk, and then you run. So think of running as investing in traditional. It's because you have developed muscle, you have developed knowledge, and therefore you can take more risk. That's how I would want us to think about investment. So characteristic number one is that they are lightly regulated. Characteristic number two is that compared to your traditional investments, they are less liquid. So it's not always easy to liquidate the investments. So say, for example, you need cash today, you can go onto the stock exchange and sell your shares. And then you will have, if you're in South Africa, you'll have your cash in 3 days. We are talking about investments here that are less liquid. By liquid, we mean that they are not easily convertible to cash. Characteristic number three, which is what I like about this alternative investment, is that they've got a very low correlation to your traditional investments. So what it means is that they don't necessarily move in the same direction as your traditional investment. So it's not as if when share prices fall, your alternative investment prices will also fall, right? It doesn't work like that. Sometimes you've got a situation where your shares are falling and then alternative investments are going up. For example, Tafadzwa, um, currencies would be an alternative investment. Currencies are negatively correlated to shares. So sometimes what you will see is that shares go down and currencies go up. That's why, to some of you who've got knowledge, you may want to play the stock market and invest in hard currency. It's because of correlation. So what we see with these alternative investments, they've got a very low correlation and sometimes a negative correlation with shares. So if you would want to diversify your portfolios, you would then add alternative investments to your portfolios. And when I talk about correlation, Tafadzo, I'm also talking about market conditions. So sometimes it happens that economies are not performing very well or market conditions are negative. Then you've got some of these, alternative investments that actually go up. And, Tafadzo, when you asked me to talk about financial news, I ended up talking about agriculture. And I actually look at agriculture or agricultural land as a type of alternative investments. I also look at cryptocurrencies as a type of alternative, investments. But I've put something on the screen here to just talk about some alternative investments. There are many alternative investments. They could be 10, 11. Here I've just spoken about 7 most commonly known types of alternative investment. So the first one that we can talk about is private equity. So when we talk about private equity, private equity is a broad sort of category that refers to, capital investments that are being made into private companies. So we're not talking about public companies here. We're talking about private, companies. And by private companies, we're talking about companies that are not listed on a public stock exchange, such as the Johannesburg Stock Exchange or any other stock exchange, for that matter. Within that private equity category, there are subcategories. So we can talk about venture capital, for example. So venture capital is capital that focuses on startup or early stage, ventures. So here we're talking about there are people who are willing to put money in startup capital. They are normally called venture capitalists. We are also talking about growth capital. So when we talk about growth capital, we're talking about money that is needed for companies to expand or to restructure, or even buyouts. It's a complicated term. Sometimes it may appear technical, but we're talking about, purchases of companies. So that's private equity. So what we are seeing, Tafadzwa, and we don't have time to show you the numbers, but what we have seen is sometimes the stock market has not performed very well, but private equity investments over time have actually performed 5 times much more than the stock exchange. And in fact, Tafadzwa, I did say that Tony Robbins saw that on average, 46% of the smart money was being invested in alternative investments. A significant portion of that is actually in private equity. We can also talk about private debt, Tafadzo. So private debt is basically debt that is not listed on a stock exchange. It's debt that is not being given by a bank, for example. It's basically debt that is sourced from private players. That's private debt. So companies get private debt sometimes. We can also talk about hedge funds. Hedge funds are basically institutions that are set by very clever people, and these are institutions that try to also invest sometimes in liquid investments, but the idea there is that they use strategies that maximize returns over time. So there is high leverage in hedge funds. Real estate is the largest market, and there are many subsets of real estate which we can talk about, whether it's land, it's commercial real estate, it's retail real estate. But in my mind, it's one of the largest asset classes. In fact, if I'm not mistaken, it's the world's biggest asset class. So we're talking about land, we're talking about and underland, agricultural land, timberland, all kinds of lands, developed land. It's the real estate. Real estate is also an alternative investment. In fact, in previous conversations that we've had, Tafadzo, we actually advised people to go into real estate as well. Then we can talk about commodities. So under commodities, we're talking about natural resources, agricultural products, oil, natural gas, industrial metals, minerals. Those are all, commodities. Commodities in the investment world are considered to be a hedge against inflation. They are not sensitive to public equity markets. So there are people who like commodities. And additionally, the thing about commodities is that their movements is normally determined by supply and demand factors. It's not influenced by necessarily economic conditions. It's supply. For example, Tafadzo, if the world is full of lithium prices go down, regardless of what is happening to economies. If the world is demanding platinum, platinum prices, go up as well. Then we've got collectibles. I've met people. I was in Western Cape last week, and I saw a guy who collects old cars, these cars from previous generations. And he does that, and he's got a very valuable collection of cars. So collectibles. So under collectibles, we're talking about rare wines. We're talking about vintage cars, which is what this guy had. We're talking about fine art. We're talking about stamps. We're talking about coins. We're talking about even baseball, baseball cards. They could be a form of collectible, as well. They can be risky. Collectible can be risky, but it's becoming a viable alternative investment. I also met somebody who, collects paintings, and he had a paint collection worth, millions. And, fortunately in South Africa, you've got companies that are able to value some of these paintings, and make sure that you don't buy things that do not have value. In my mind, the key skill that is required as far as collectibles are concerned is experience. So you need to go into that community, and become a true expert on what is valuable and what is not, valuable. Then we can also talk about a number of structured products. You can structure products from particularly your fixed income markets, and come up with a number of structured products. Some of these structured products tend to be what they call derivatives, but we'll talk about these later on. But broadly speaking, these structured products are new within the investment landscape. You might have heard of subprime assets during 2007, 2008, that were the cause for the global financial crisis that we experienced. It was essentially because of some of these structured products. There is also money to be made. So that's in a nutshell. This is not a comprehensive list by any stretch of imagination. You can also include here cryptocurrencies as well, Tafadzu.
Thank you very much. Liz Baker says, now I understand. I'm not sure exactly what she understood, but I'm glad that there's someone who understood what you were talking about. Because when you were talking, I was actually thinking maybe we can have a show where you answer the next question, which is how can the ordinary investor access these alternative investments? Because maybe someone was just listening and they were wondering what you are talking about. So maybe we could have a show, our next week's show, where maybe you can explain these things and how an ordinary investor can access.
So let's do that, Tafadzo. Let's leave the detail around how a man or a woman in the street can actually access these investments to next week. Let's talk about it as part 2 of what we are discussing. But there are 2 things that I want to say, Tafadzo. The first thing that I want to say is that when I read this book by Tony Robbins, he also spoke about access. So you might understand what alternative investments are, but access is the key thing. Some of these investments, particularly in America, are not necessarily accessible to the man in the street. So these are things that are only accessible to the rich. And sometimes the rich give each other some of these investments. You are actually invited to participate in this investment. You may be wondering, Tafadzo, why the rich are getting richer. One of the reasons why the rich get richer is because they give these investments to each other. So when you've got a certain level of wealth, you are then invited to participate in those investments. If you are poor, you will never be invited to participate, say, in private equity, because you don't have money to begin with. And when they participate in these private equity deals, they make more money. That's why, in our predictions before, Tafadzo, you might have known, and we did say that in an earlier presentation, inequality is not getting better. Inequality is worsening. So that's the first thing that I want to say. The second thing that I want to say is that in America, we have begun to see legislation which is aimed at democratizing access, because it's not moral that these kinds of investments are only available to the rich. You have to democratize, the process. So there is no question in my mind that democratization will happen and is happening, but you can't democratize something when you haven't given knowledge. And that's the role that I would want us to play, to educate people, so that when these, because there is a risk in these kinds of investments. Granted, some of the risk is, asymmetrical. We're talking about asymmetrical risk. You're looking for opportunities, but access is very, very important. So I just wanted to highlight that, Tafat.
The Bible in Proverbs 22 verse 7 says, the rich rules over the poor. the fact that maybe some of these things, they need to be repeated, shows that I haven't yet reached where I can be invited to discuss these alternatives. Any other thoughts?
You know what the Bible also says, Tafadza? The Bible also says that poor you will always have. So poverty, as far as poverty is concerned, poverty will always be there. And never think that poverty will be eradicated. I think the only way in which we can make a dent on poverty is through education. It's something that, the Bible also says that the poor you will always have. It's granted. The only way to take yourself from poverty is not waiting for, the day that you will win the lottery. It's just by educating yourself and developing. So to us, Tafadzwa, coming out of poverty is in three ways. Number one, you need habits, the right habits. Number two, you need the right mentality, just thinking the right way. If your mentality is not right, you will never come out of poverty. Number three, you need the skills and knowledge. So think of it in those three ways. If you would want to be a very rich, financially independent person, the first thing that we advise you to do is to change your thinking. So don't have the kind of thinking that says money does not grow on trees. No, money is actually growing on trees. Don't have the mentality that says you need money to make money. No, you don't need money to make money. You need knowledge to make money. So people have got the wrong mentality about money. Never have the mentality that says money is the root of all evil. Then if you've got such mentality, also never have the mentality that you need to work hard for money. So if you would want to come out of poverty, have the right mentality and the right thinking about money. That's one. Secondly, develop the right habits. Habits are very, very important. For example, the habit of saving, the habit of tithing, the habit of looking out for opportunities wherever you are. You need to entrench those habits. We've been talking about frugality, Tafadzo. Frugality is a habit. You need to develop that habit. And then number three, knowledge and skills, right? Particularly diversification, how to, perform a due diligence. That's what you need, Tafadzwa, to be able to join these rich people that we've been talking about. But let me stop there, Tafadzwa.
Thank you very much about that. Lizika says right habit, right thinking, knowledge and skills, poverty breaking point. I agree with you there. What would be your closing remarks, Themba? And where can people find you?
So my closing remarks is that we are living in a world of opportunities. We are living in a great time. Inequality will never be solved in our time. But what we need is knowledge. We need the right habits. We need the right thinking. I think let me just conclude there, seeing that time is not on our side.
Thank you, everyone, for joining us this afternoon. We appreciate you, and we don't take you for granted. We hope we are applying the knowledge so that one day you look back when we are invited to discuss alternative investments, and we say, "Oh, we learned that. We didn't know." But I look forward to the day where I will be invited to discuss alternative investments, and I hope you will join me then. Thank you again for joining us. And if you want to communicate with us, you can write us an email at tafazamazibuko.speaks.co.za. You can also visit our website, www.tafazamazibuko.speaks.co.za. You can also like, subscribe, and share our YouTube channel, The Dream That Was Worth Fighting For. Enjoy the rest of the weekend, and your dream is worth fighting for. Let's grow together. Thank you and cheers.